Welcome everyone, and just going to keep this nice and short. This is the FTSE on a daily chart, and you can see we're just going nowhere. I think you will agree. So this is a 20-day average. That's all we've got on there, plus volume at the bottom. And if I look at, let's put the data back. So this is the FTSE with the Fibonacci levels ratio back to last year, 2022. And you can see that 2022 highs was 76.88 area, which we failed from on several attempts. So we started the year well. We popped up, held that level I just mentioned, and went up. And subsequent highs have always been sold into. So we got sold into in March, late March, early April, late April, early May, and then we dropped into 23 support, 23 lows, but we just could not get back above this 22 high. And here we are in this channel, knocking our head on the top of this channel, with jobs tomorrow potentially going to come out of that. So I've actually shorted the highs. I'm going into the jobs number short. If I'm wrong, I'm going to get stopped out. I'll stop just above these highs. And if I'm right, we should start to fall through this level here, through the 75 level, and ultimately into the new year, we might even end up down here. Now, this is complete contrast to the US. So look at the Dow. Right, come on down. There we go. So we're making new 23 highs on the US, and yet the UK market is just struggling. Our GDP levels are pathetic. We're bumping along the bottom, whereas US has got 5% GDP at the last count. And that's showing in these markets, because if we look across the Nasdaq, we are sitting up very nicely, and even the Nikkei Japanese market is sitting up, having pulled back. These charts are very slow today. My apologies. I'm not sure why these charts are so slow. There we go. So we pulled back. This recent level was a key level of support. We've already had a breakout to 23 highs, and we look as if we can challenge 23 highs again. Because if this pullback holds, I think we can break these highs, whereas the UK is just struggling. So be careful. It's been a difficult year to pick good UK stocks. The key this year seems to have been to buy good solid stocks with good balance sheets like BT and Rolls-Royce and sit tight. Talking of which, this is oil. Sorry, this is oil coming off of so $70-$40 was the 22 lows. We just come underneath it and punched above it on Friday, and these pullbacks at the moment are getting bought. So it's a busy week. We've got US jobs. No, the US jobs on last Friday. You've got UK jobs tomorrow morning at 7 a.m. before markets open. Bank of England, ECB and Fed all on Wednesday and Thursday this week. So it's a very, very busy week. And the markets are based, particularly the US markets, are pricing in rate cuts next year. The common held belief is that again, not everybody believes this, but the belief is that rates have gone too far too fast and the Fed will have to pull back. If the Fed pulls back, then other central banks like ECB and Bank of England will at the very least not have to increase rates and they may well follow. Okay, so let's have a look at in the meantime, the gold is just, we blasted up on the Sunday open last week and we are just falling right off now. The oil, so gold tends to do this. It blasted up on the 3rd of May and then spent right into October drifting back. So next stop, the main pivot support seems to be here at 1968. I got my eye on this 1830 gap. This could be the start of the process where this market comes to backfill into the 80-30 area. All right, but if we go back to the dollar index, dollar index is coming off of this support and perking up. So it's a crucial week with all these rate decisions. Is that US rally sustainable? Key question. So are we going to have a recession next year? Let's have a look at the FTSE again. Let's just ask ourselves a question. Is the FTSE suggesting that we could see a recession? My view is that this aggressive interest rate rise that we've had has really knocked the housing market for six. We're seeing negative numbers month on month at the moment in the UK. And I believe that this interest rate cycle has not impacted the market fully. I don't think it's fully bled into the market. I think it's lagging. A lot of mortgage holders have come off fixed rates in the last 6 months, and I think the UK consumer is strapped for cash. Therefore, that's why I'm shorting high into this channel. If it gets stopped out, then I'll rethink. But maybe we plow on back up to this magic 76.88. But if this is that we've closed lower on the Monday with a pin bar, um, suggesting that this market's in trouble, and that's why I've shorted with a stop above these highs. So obviously, I will, as I said earlier, if I get stopped out, I will walk away. But like I say, I think if we close underneath 74.5, 74.50, then I think this market is going to pull right back. Apologies for that delay, just sorting out a message. So whichever way we come out of this area here, for me, is Mr. Market telling us what it wants to do. Now, maybe we need to get, this is the short term, but longer term, as we get into next year, as we get into the new year, into January, if we cannot rise up, if we do drop down into this 74.5 and can't raise above it, so I just realized my microphone was turned off. So if we find ourselves underneath 74.50 in January and we can't close above that 74.50 in January, then I would look to go under seven, retest 7,000, and ultimately come down to possibly as low as 6,000 or more. Let's look at if you look at the quarterly levels, look at this quarter level. So we're still we've never really got out of this this COVID quarter. I mean, we've never closed above in this quarterly. We've never closed above 7,900. So a couple of lower closes on this weekly, and I think this could come toppling over. If you look at leading bellwether stocks like, let's pull up my charts. So they've changed that, they've upgraded the platform, and I'm still struggling to get hold of this. Right, here we go. Let's look at Barclays, key bellwether stock on a quarterly chart. You can see how flat this is, and we're just scraping along the floor. You've got a low down there of 74, and this is the 76. Let's take all this off and just have that one on there. So that is the first quarter in 76. Got pumped up in the third quarter of 2016. And we just never come out of this range. So that's why that's why I think this range has got to be broken. I think we need a decent pullback, a decent corrective wave down in these stocks to get everybody interested again and to get this market moving, to get some liquidity back in this market. Look at retailers. Let's look at W.H. Smith's. Again, it's never come out of this. Yeah, that's not true. We had a couple of quarters lower underneath this COVID bar, this COVID the first 3 months of 2020, and then we're back in it. We're just back in the lower end of that area, Sainsbury's. So it's very, very difficult. One of the great stocks of this year has been, I have to find it here, Rolls-Royce. So here's where you have a deeper pullback. So this was way up here at above the £10 mark, and here we are just bumping into 3, having had a low of 66, 70p not that long ago. So this is why I think you need a flush to the downside in these markets to get some volatility, in the market, flush out some weak hands and get some liquidity in this market. And then perhaps we can start picking off some good quality trades at lower prices and see a recovery. Let's have a look at things like ASOS, as seen on screen. Horrible stuff. Look at this. It was up there at 76. I mean, we're now £4. But the volume appears to be attempting to come back. We're back down here to 2010 levels. No, even further back than that. We're back here to the post-financial crisis levels. So that's why we've got to be very, very careful with this market. Cash is a position. So do not be afraid of sitting on cash, particularly as we complete this year and get into next year. Don't rush to get into these stocks. Let Mr. Market show you what he wants to do. and let the markets come to you. But this is one of the reasons why I am bearish the UK market and just standing aside on the US market. But I have last week I was buying lows in this oil. In the trading room, I suggested can't remember the exact price now. Yes, I can. I think it was about I suggested an entry on Friday. I think it's about $70.20 or something. I'll have a look back. And I think it was Thursday. Yeah, I think I suggested on the Thursday low, held overnight, and we are still picking up as we get going on this week. So my message to you here and now on the 11th of December, as we are fast approaching the remaining last few trading days of this calendar year, with a lot ahead of us. Three central banks having meetings this week and making announcements on rates, plus US retail sales, plus UK jobs. Yeah, just be very, very careful and look at the bigger picture. Let's get back to the weekly charts. Weekly charts are my favorite time frame. So this is oil on a weekly chart. You can see we came up from here in July. So we could be about to run back up towards the 80. I think the mean average in oil is $80. That's about the middle of this price range for this year. So we're just coming off $69, attempting to get through $72 as I speak. So I think this and energy related stocks is a good option to look at. In the meantime, be very, very careful, particularly as gold, particularly with miners. In fact, I haven't checked miners today, so because I've been too busy. Let's have a look at miners. Yeah, we've seen some significant pullbacks. This is Pan-African. A couple of weeks ago was up there at nearly 19, and now we're only just above 15 and a half on the back of that weak gold. All right, I'm going to leave it there. I think a lot of people have had trouble logging today, so I'll look at that and sort that out. Zoom did an update, and I think it's caused a lot of problems. Right, so I will hope to see you soon. If you're not in my Telegram trading room, then message me from tradeeasyway.com and I'll get you in there. All right, thanks very much, and bye for now.